Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, our analyst. We're so happy to have you here for this last Market Carver of September. We turn the page going into the fourth quarter and what's been certainly a tumultuous third quarter. So we just got a few brief points to give you today. This is our the first of our thirdly weeks, so several meetings. Hopefully we'll see all of you all where you can come and hear more. But certainly these will be a couple of the topics, but two things on the Fed, which quite frankly get tired of talking about. It seems like each and every week. However, there's just no way around it. That is the centerpiece to this market without a doubt. And they had a meeting last week, so we want to update you on that. And then Zach's going to cover the housing market, really one of the most integral pieces and important part of the U.S. economy. So we always like to stay on top of that. And he's got some, I think, good thoughts on that market. So why don't we just go right into talking about the Fed? And this is important. The first chart here we're going to look at is the clarity with which they are speaking. So this is an index, which is kind of interesting for the linguistics that they use. So you can look at the various education levels that have been required to understand Federal Reserve members in the past, going all the way back to the Greenspan era. Now, Greenspan actually had a knack for and a reputation for using words that were intentionally confusing. He wanted to leave something up in the air in terms of what he said, leave it ambiguous or open to interpretation. So he was kind of famous for that, but Bernanke took that to a whole new level, and to the point where it required a postgraduate school to understand fully what he was getting at in his language. Yellen brought it back to earth a little bit, and then Powell is using as simple terms as possible. In fact, it just takes a middle school education to be following what he's doing. I believe that's very intentional because right now they don't want there to be any sort of confusion. They want everybody to get the message in terms of what they're doing, particularly when it comes to inflation, which can be unpredictable. And so the more people understand what they're doing and trying to fight inflation, I think the more successful they will be. So very intentional here. And the market is very clearly getting that message. In terms of the interest rate increases. So that the size of not just the real short-term rates, but the long-term rates moving up as well is an indicator that they are finally and catching up with where the Fed wants to go long-term with those rates. So to that end, we also got the widely expected 75 basis point increase last week in rates. And you can see how this expectation has tracked over time. For quite a time, we were right there at zero essentially for rates until earlier this year when the projection kept going up in terms of how far the Fed will have to go with rates. And right now it's over 4% that the market widely believes, and the Fed has put out there as a forecast for how far they will need to go to really complete this cycle and raise interest rates. So that means that there's a little bit more to go, but we're much closer to the end of this hike cycle than we are the beginning. I think that's the good news. The bad news is there's a little bit left to go here. So somewhere in there, we're passing the baton from a Fed that had been easing, and we're dealing with those lag effects and entering one where they have now been tightening for several months and may have another 6-12 months of market adjustment, an economic adjustment to deal with those lag effects. So that's where we are Fed-wise. Turning now to the down and dirty of the housing market. Zach, I'm going to turn this over to you in this important piece of our economy.
Yeah, so as Adam said, the housing market, really crucial piece of the U.S. economy, which makes it really important for us to keep our eyes on, in terms of total economic outlook and especially with idea generation, right? There's a lot of spaces within the housing market that can be good for investment opportunities. So what you're looking at here is a chart of housing starts or new homes being built. And what you can see in the early 2000s and even the late 90s leading up to the economic crisis of 2008 is that we were outperforming or overproducing the long-term average of 1.6 million homes. That 1.6 million comes from 1.5 to 1.6 million comes from 500,000 or 600,000 to replace destroyed homes, and then about 1 million for population growth. So you can see, especially in the early 2000s, we're far above that 1.5, $1.6 million long-term average, meaning that we were overproducing houses. And then in the great financial crisis, started to really underproduce. And then starting in the early 2010s and really up until recently, within the past few years, have been well below that average, significantly underproducing what's needed for home replacement and, as I said, population growth. So even though the general housing market, we've seen some significant price increases over the past couple of years, even though there's some uncertainty around the direction of housing prices specifically, one thing that we're looking at is remodels, and the wave of remodels that could be coming into the marketplace could bolster some of these companies that supply products and materials for remodeling. The average or optimal age for a home that is being remodeled is 20 to 40 years old. And so you can see back in the early 2000s, when we were overproducing homes, there was a large influx of homes. Those homes are now turning 20 years old. And so with the remodel age, the prime remodel age starting at 20 years old, we have what we would expect to be a large influx of homes hitting that prime remodel age, ready to be updated, should positively benefit some of those companies that, like I said, provide supplies for remodeling and could provide some investment opportunities moving forward.
Very good. Excellently done, Zach. And I think that you're absolutely right. Wherever this overall market goes, it's our job to find opportunities that we think can make sense. And that's really what we're starting to see. I know that we've had a lot of talk about our defensive posture, about things not looking great in the market. And most of you probably wishing we were even more defensive than we've actually been, but just can't say it enough. We have no idea exactly what the time frame is on the overall market structure. We have to be diversified. But increasingly, some of these stocks, particularly in areas like this, where there's a remodel wave coming, that have come down in price, really believe in the next quarter, maybe a couple of quarters, we'll really be needing to plant some of this money that we have on the sidelines into these stocks that have come down. That doesn't mean next week or the following week, but over that time, we're going to be more judicious in some of these opportunities that are being presented to us. So if anything, that's the silver lining here, is that we've got opportunity for stocks that have just been really absolutely pummeled this year. And this is going to really give us a great opportunity going forward. So hope to see you at the third leads where we can talk more about this stuff. If not, you can always come in and see us, 800-928-4001, the number to give us a ring, or scan this QR code and schedule it electronically. Either way, thank you all for the time and hope you have a great weekend.